All right, Lyn, hi.
Hey,
Welcome back to Europe.
it's great to be back.
Do you want to pull the mic in a little bit?
Sure.
Yeah. You're traveling a lot these days.
Yes.
A lot of demand on your time.
Yeah, I think this is my 4th international travel so far this year, and we're not even halfway through.
You're traveling like I am now, the other way.
Pretty much. It's hard.
It is hard.
Yeah.
Yeah, it's really hard. It gets to be a bit of a drain, but Norway's pretty cool.
Yeah, I agree. My second time here.
I had to miss the last couple of years because last 2 years I was with Craig Wright,
Oh, that's right.
our mutual friend. Well, anyway, I want to talk to you about central banks.
Sure.
Has Danny pre-warned you?
Nope.
Oh,
Going in blind.
big topic. I want to talk to you a bit about central banks because there have been kind of growing, almost like a growing legitimacy behind the idea of not having a central bank, not having the Fed. Whereas before it felt like a radical kind of fringe idea.
Yeah.
It's not just Ron Paul, it's not just the Libertarian Party. I think one senator, didn't the senator put in a bill recently suggesting ending the Fed?
Yeah. It's one of those things that won't pass, but it's a signaling mechanism. And it just kind of shows more people are kind of fed up, for lack of a better word.
Rightly fed up?
I think so, but I think, there are a lot of things that are blamed on the Fed that are not necessarily directly the Fed's fault. The way I've been phrasing it lately is because of fiscal dominance, central banks kind of find themselves more restricted than normal. It's hard to be truly independent when debts and deficits on the public sector are so big. But I think it's one of those things where you can see why they wanted a central bank. But I think it's kind of unique to a specific time period of technology. So, and one of the things emphasized in the book, Broken Money, is kind of pre-telegraph, everything was analog. Everything moved at the speed of analog. And so even though we had banking, we didn't really have fast banking. You could only move around ledgers as quickly as you can physically go someplace. But ever since we invented the telegraph and then telephone and all this kind of range of technologies, now money's going around super fast, but we still couldn't do settlement quickly. So we kind of had to have someone abstract a lot of that for us, and it was kind of prone toward centralization. I think that's really kind of why the same model took hold everywhere. But I think that as we leave that era, as we actually now have ways to do fast settlement, basically payments and settlements that can't be reversed, it starts to kind of show that maybe you actually don't even need a central bank.
Well, we don't have a central bank with Bitcoin.
Yeah.
We have a protocol and we have consensus,
Yeah.
but we're a long way, I still think, from just being on a Bitcoin standard and not having fiat currencies. And it's very easy to join the chorus of end the Fed, chanting it. But I'll be honest, I only would say that because other people say we should get rid of central banks. And I don't understand fully the reason behind it. I understand the kind of the general sentiment, interference, that a few guys in a room are making decisions which have this butterfly effect through the economy, which can be devastating. But like what I wanted to get out today is just understand a bit more. So if at least when I have an opinion on this, it's an informed opinion and you're the best person to talk to about this. So I think a good starting point would be kind of a short history of central banking. I don't know how much you know to recall. Why we need them, talk about the things perhaps that they do that nobody understands, go into a bit more detail about how they're hamstrung, but then also maybe kind of consider a world of no central banks, but still having an economy which is both fiat and Bitcoin. So there's a lot.
Yeah, a lot to go over. I mean, so they started in Europe centuries ago, and Bank of England was one of the first ones.
Yeah.
And that was originally kind of put together to help fund war. That was kind of one of the original purposes of it. Today, kind of the main purpose of a central bank, ostensibly, is a lender of last resort. So because fractional reserve banking is inherently unstable, and it's kind of prone where if one bank fails, it's more likely to lead to like a cascade of bank failures. There are periods of time where there's all the liquidity kind of dries up, and they want someone to be able to come in and say, well, we can lend when no one else can lend. That's kind of the idea of a central bank. But it's become more entrenched over time because in addition to that role, they actually run the foundational ledger for what money is. Like if you say, what is a dollar, right? It's a piece of paper, but what actually is it? It's a direct liability of the Fed. So basically the monetary base of a country is the central bank's liability side. Right. And so we run this two-tier money system where the base money is the liability of a central bank, and then the broad money are the liabilities of commercial banks. So bank reserves and physical banknotes are direct liabilities of a central bank in most cases. In the United States, it's the Fed, and so that's a really foundational role. Like you really define what money is. You control how much of it there is, how much base money there is. There are other policies they don't directly determine, but they heavily influence how much broad money there is. They either accelerate bank lending or reduce bank lending, and they facilitate funding the government, even at times where if they were to go issue bonds, nobody wants to buy them. Central banks buy them. And so they serve multiple roles today. But I think a lot of people are rightly concerned around the centralization aspect, which is to say, if you ask most people, are price controls good? Most people that have a sense of free markets would say no. And yet that's exactly what central banks do. They set the price of money, which is arguably one of the biggest, most important prices you could set. It influences everything else. And if they don't set it right, if they don't set it in a way that is like rational, then it has all sorts of distortion effects on the economy. And that's why people get frustrated with it. And it can contribute to booms and busts. I mean, they're supposed to be there to smooth out booms and busts, but they have a tendency to be kind of almost pro-cyclical, where they kind of cause a bust, they cause a boom, they cause a bust, or at least they contribute in a significant way, many would argue.
All right, I'm going to have questions. Can we start with fractional reserve lending?
Sure.
Actually, but go back a step. So you talked about the birth of central banks was the lender of last resort. Is this from the era of free banking when essentially banks would fractionally reserve, but because they never had the gold to back up, they would kind of, were they say getting greedy because they should have been full reserve? And
well, some of it is actually market forces, which is to say, like if you trust a custodian to hold something for you, you're trusting that they're actually going to have it. And if it's a non-fungible item, like a safe deposit box, they can't do anything. They have to keep it there.
Yeah.
But if it's a fungible item, like a monetary-like asset, like gold, then they can say, well, that person doesn't need the same gold bar back or the same gold coin back. We can just have a big vault, bunch of IOUs that we owe this gold. And then they say, well, every year, only like 10% of people there's very low churn in terms of people coming in and taking their gold out. And they're saying, well, probabilistically speaking, we don't have to have all of it here all the time. We can have a big buffer. We can have half of it. We can have a quarter of it, and it's still more than the normal year. And so what you get is fractional reserve banking. I think a good way to describe it is mismatched duration lending.
yes.
So people often think that a full reserve bank doesn't lend, but that's not the case. It basically just means that if you're lending out money to a business or something or any sort of purpose, that the money that's funding that loan is locked in for a period of time.
Yeah.
So basically someone else has to forego spending. They have to lock up money. So for example, they can buy a certificate of deposit at a bank, lock it up for 2 years or 5 years, whatever the case may be, and then banks lend out of that kind of time-locked pool. Whereas what happens in practice with fractional reserve banking is people put their deposits in. They think they can pull out at any time. They have the right to add more deposits, pull out the deposits, but the bank only has a certain percentage of that there because they're lending that into less liquid and longer duration assets. And so they might be solvent, but they might not be liquid when people actually want to get out. And so that's inherently unstable. It's kind of reliant on probability. And the problem is that once a bank starts to fail, people suddenly get nervous about other banks and it kind of cascades on itself. So it kind of works for years or decades at a time and then kind of breaks all at once.
But if you had more of an era of free banking and the banks issued their own money, so you'd had a Chase dollar or JPM Morgan dollar, that shouldn't really cascade as much. Maybe a little, but
you think it'd be self-correcting. I mean, there's it's often pointed to in the U.S. that the age of free banking was not very successful, but it wasn't very free. There was basically different states had their own rules, And so, generally speaking, if you could diversify your deposits more, you'd have less of a chance of a bank failure. The U.S. was really an emerging market back then, whereas free banking was more successful in places like Canada or Sweden, kind of those other markets that were more developed at the time. But either way, it's just kind of foundationally unstable. And that's why over time, a lot of it centralized. Even, one of my favorite books to cite is William Stanley Jevons' Money and the Mechanism of Exchange, 1875, because he lays out everything that's going to happen in the coming decades. He's like basically pointing out how almost every solution for every friction in finance is centralization. It's like, if I want to send you money very efficiently, we can use the same bank, and I can, just kind of say, okay, take away from my account, add to his account. If we use different banks, then our banks have to be able to communicate, and so they end up tying into a central bank or a bigger bank. And then even internationally, like, if you're in Britain and I'm in the US and I want to send you money, they have to have a way to coordinate. So often, historically, they would coordinate around whatever the biggest central bank is. It's basically ledgers built on bigger ledgers, built on even bigger ledgers. And so for literally centuries, as we got more and more complex with finance and wanted to solve all these frictions, every single one was solved with more centralization. And so he's in the book, he's saying, look how hyper efficient this is. We can move around all these claims, and gold almost never has to move anymore. But then at the same time, he's like, it's levered 20 to 1. And this is in the late 1800s. It's like kind of what people point to as technically a sound system, gold standard. But under the surface, even back then, it was levered 20 to 1. And he's like, if 5% of people show up in banking hours and say, I'd like my gold back, it's not there.
So is it really a choice of, you can either have fractional reserve lending and centralization, or full reserve and decentralization? You can't have a decentralized fractional reserve. You
can for periods of time. I mean, it's somewhat self-correcting. You have bank failures.
There's no lender of last resort, though. There are situations. You're not going to have liquidity. Like in the Bitcoin world, if something fails, you lose your money.
Yeah. The only basically a bigger actor can come in and backstop it, but they have a finite ability to do that. They can't just print it. With gold, basically, it's very slow. And so people generally don't challenge the banking system too often because physically withdrawing it was a burden. And in a fiat world, people don't really think too much about it because whenever there's an issue, they just print more fiat. There's not really too many cases of fiat, like a fiat banking system with no central bank. Because the whole point is that instead of kind of relying on nature, like gold, to be a foundation, they rely on this like central bank to be a foundation. And so that's kind of where we find ourselves.
All right, here's my questions that might seem really dumb. In a fractional reserve world, the banks can lend out more money than they have, and so in the 1800s they would just create new, I guess they're IOU bank promises. Yeah. They're kind of banknotes, and in the current world they're digital.
Yeah.
But in the case of fractional reserve, new money is being created to lend out.
Yeah.
And at the point where the money's, to say there was we're a very small economy and there's 100 borrowers and everyone fractionally borrowed. If we all borrow, we increase the money supply.
Yeah.
Does fractional reserve lending also create inflation?
Yes. Yeah. For example, in the 1970s, most of the money creation back then was from bank lending. That was kind of the most rapid rate of bank lending in U.S. history. And there were deficits at the time that were contributing to inflation. But really, it was the expansion of private sector bank credit that really drove the growth of money supply. And a lot of that was tied to demographics. You had baby boomers that were born starting in the late 40s, and they were entering their home buying years, which on average were earlier back then than they are now. And so that was kind of the period of peak credit formation. You had an unusually large generation all kind of heading together and getting mortgaged at the same time. And so you get a ton of new money supply entering the market. And it's not specifically because of the central bank. I mean, their base money supply was not growing very rapidly, but it was that layer of broad money on top of it. And when decades later, when the central bank kind of increases the monetary base, they almost like lock in those prior decades of bank lending. Because
right.
if they had held firm, for example, whenever there's a banking crisis, you'd have the broad money start collapsing down toward the base money. You'd have a period of deflation.
Would you say that's just a correction and a healthy thing?
Well, I think so under a system that operates normally, that would be healthy. I mean, as far as fractional reserve banking exists in the first place, basically, at least it clears it out. The problem is that they never let it clear out. They never really let those things fall down. And so if you let that go on for a decade and get so levered that it's, say, 20 to 1 or 50 to 1, then by the time that starts to unravel, it would kill almost every bank in the country. And so you get like an incentive problem where nobody really wants that to happen. No one's going to vote and say, you know what, I want all my bank deposits to be wiped away, and I want, all this kind of cascading thing. So everyone's like, okay, just fix the problem this time, and we'll sort it out next time. But then never sort it out.
Are there any objective measures that credit creation via the banks for fractional reserve, the inflation that causes, is net better for society than inflation caused by government printing to fund their own activities?
It can vary. I think when you look at both emerging markets and developing markets, inflation can be generated either way, either from excessive bank lending or from large monetized fiscal deficits. Private sector lending is at least more distributed. It's a bunch of individual people making a loan that seems rational to them at the time. So someone's borrowing money, someone's lending money, but they can still be distorted by some of those central bank policies. So, for example, if they hold rates too low, it can encourage sometimes too much bank lending, or if they hold rates too tight, it can really slow down bank lending. But then they get kind of like their models don't always work the way they think they do. So, for example, in theory, cutting interest rates is supposed to kind of energize bank lending, because if you're not going to borrow at 7% for a mortgage, maybe, but you might borrow it at 3% mortgage and buy a house. So you're more likely to borrow. But the problem is that if you drop rates too low, banks are reticent to lend, because they don't really get compensated for the risk they take. And so there's kind of diminishing returns. And so basically the problem with the centralized aspect is that if they're not kind of correct in how they're doing it, and there's way more ways to be wrong than right, then you're likely to get some sort of distortion in the economy. Some money's being created for purposes that are not very suitable, or you're facilitating bubble growth, which might feel good at the time, but then it's going to feel bad later. So for example, the 1920s were booming, but a lot of that was because of unsustainable credit creation, and then that's what directly contributed to what was far worse in the 30s and thereafter.
And was there a benefit when we had, say, close to 0% interest rates? That didn't really benefit the pleb, the peasant so much, unless you could get on the housing ladder and maybe get a 2% interest rate. But it seemed that it benefited investors, hedge funds, VCs very well.
Yeah, very good for asset prices, very good for unprofitable companies. Basically, when money's weak, you monetize other things. So people monetize real estate, they monetize the stock market, and they just kind of plow money into those other things. And that has distortions. It can, for example, favor big companies over small companies, because small companies are reliant on bank lending, and they're not generally held as inflated valuations. So cost of capital is higher to them, whereas everybody just piles into a market cap weighted index like the S&P 500. They just keep giving the biggest companies even cheaper cost of capital. And it's like on autopilot, and it's like a vicious cycle that kind of keeps feeding itself. Or, one of the biggest problems is just monetizing real estate. It's something that should be for utility. But when people say, I don't know what to do with my money, I don't want to hold it at zero interest rates, I'll buy another property. And sometimes you'll buy it and you'll literally leave it empty, because it's better than just holding cash. And that drives up the valuations of houses, which feels good for the people that own the houses, but it feels really bad for people that are locked out of the housing market because of that.
Right. Okay. So it does feel like the free market for money would be a much fairer and less, I don't want to say less volatile, because we would have market forces, we would have cycles, but we would potentially avoid the massive systemic issues that we saw in 2008, or we feel that might happen at any moment today. I think Kurt was just telling me earlier that bank losses were reported today up to what were the numbers? 550 billion?
530 or 40 and a quarter.
Yes. Yeah. And so it feels like the one of the primary issues we have with central banks is they're not allowed. They're basically governments are not allowing corrections.
Yes, and then the problem is when you don't get small corrections, they kind of boil up to something far bigger. And then that's a much worse correction when it happens.
Is that essentially the issue? Is we politicize central banking, and if we didn't politicize central banking, do you think they would operate significantly differently?
I think the problem is the incentives always point toward helping the government over time.
Yeah.
So in theory, for example, they're not supposed to monetize the government debt, but then they'll still buy bonds and hold them indefinitely and say it's not really monetizing the government debt because we bought it on the secondary market. They always kind of do roundabout ways. And then even intentions to try to be independent can just get overridden. If there's a war and Congress can just pass bills and say, well, you're not really independent anymore. And even at the current time, like you mentioned, the bank loan losses, the Fed itself and many other central banks, they actually have losses on their books. Like the Fed's, right now, their equity is negative. They actually have losses. But unlike a bank, no one can do a bank run on them. And so they don't have that issue. But how independent can you be when you're indebted to the Treasury? Like, they're supposed to be separate from the government in most important ways, but they're literally indebted to the entity that they are supposed to be independent from. So
it just feels like we have a growing bubble that feels like at some point is going to explode in ways none of us have experienced in our lifetimes. Like the levels of debt that exist seem astronomical. The amount of debt that the government has, 34 trillion here in the US, whatever we have in the UK, like something feels like it's going to break.
I think, well, what's funny is it normally does not break where people expect it to. So most people have a tendency to fight the last battle. And so, for example, in the late 90s, we had this huge stock bubble, and then that collapsed. In the 2000s, we had a big real estate bubble, that collapsed. And so many people are looking today at all these inflated asset prices and saying, well, we're ready for the collapse. But the problem is that the bubble is now in the sovereign debt market. It's treasuries and currency. And so one way that can resolve itself is kind of a longer period of above average money supply growth, which has all sorts of negative effects. I mean, the most obvious one is price inflation, but that it can even show up in things that don't necessarily show up in CPI. Like, for example, house prices could be completely out of reach to people. And even though they get CPI back down to 3.5%, they say, well, look, it's headed in the right direction. The cost of owning a home is astronomical right now. And so I think that basically this is the type of issue that instead of being one big implosion that kind of all happens at once, I think the resolution of this bubble is probably a longer term grind because it kind of gets diffused through the currency itself over time.
Through inflation.
Yeah.
Which means, I mean, we've been talking about this for a couple of years now, and you've said you think the story of the next decade or so is going to be inflation.
Yeah.
And do you think, I spoke to Luke Woman, and I think it was Luke, he thinks there's a high chance we might have triple-digit short-term inflation to wipe out the debt.
So it's one of those things where that could happen. It's hard to predict something like that because it's a very extreme thing. So you're going to be wrong most of the time, but if you call it, you're going to be, it's a good call if you make it. My general base case is just higher than normal inflation for a pretty long stretch of time. But there are events like energy shortages or things like that that can get you a more extreme outcome. And basically it happens all the time in emerging markets. And what's different now is that the developed countries have this, and they've not really had this issue since the 1940s. And so a lot of people's models don't really go back that far. Their careers don't go back that far. Their models don't go back that far. And there are ways to mask inflation. Like, for example, if we get AI-driven productivity increases that keeps, say, white-collar wages down because people are now competing with AI and we need fewer workers, or we can churn out more things because of technology, that can suppress the prices of many things. But then it still shows up in asset inflation, things that are truly scarce, things like houses, things like art, things like gold or Bitcoin, energy when you have an energy shortage. So you can have very uneven inflation. So I do think that a lot of it will show up in things like CPI, but I think even to the extent that it doesn't, it's showing up somewhere else. And that is also harmful, even though if you're on the right side of it, it can feel good.
Yeah, look, holding Bitcoin has proven to be a good strategy over the recent inflationary period and probably will continue to do so. But it does feel like this period of high inflation is going to have few winners and a lot of losers. It's a real squeeze on society, the middle class and the lower class especially. How does that correct over time? Or is the trajectory of this always, we're going to always have a widening wealth gap until we have revolution?
So partially it depends on, there's kind of two ways to do it. One is revolution.
Yep.
And then one is kind of a more controlled one where you kind of do it more intentionally. So back in the 40s, for example, there was this wave of communism happening. And the US basically did a thing where, okay, we're going to get a little bit communist for a period of time, and we're going to do some redistribution, but not as much as most other countries did. There was this big, and it was kind of all tied up in the war as well. So when GIs came home, it's like, okay, we'll fund their education, we'll fund their technical training, we'll subsidize their mortgages so they can get a house, interstate highway system, things that were fairly popular at the time. And if you do that productively, that's one way to do it. They actually did narrow the wealth gap for decades.
Where did they take that money from?
Basically from bondholders. So anyone holding bonds or currency got screwed. They also did extremely high tax rates, but people still kind of felt in it together in a sense. And so that's kind of like it's almost like the MMT's dream of how they want it to work out, which is, okay, we kind of diffuse the money from one place to another and it all kind of works out and we kind of emerge stronger from it. But the problem is for every one of those stories, there's 10 stories where it goes completely off the rails and you get more of an Argentina or any number of other things where you start distributing and then it just kind of keeps spiraling. And people realize, if you can do that, why not just keep doing it again and again and again? And it's very hard to do it a little bit.
Yeah, because this is what it feels like we're heading towards. Even with my businesses, I can see the real world impact of inflation right now. And then you talk to your friends, you ask them how often they're going out, how inflation's impacted them. It's kind of impacting everyone, but especially kind of middle and lower classes. You're seeing businesses close down because they don't have the customer base, yet their costs are going up. I can distinctly see this wealth gap widening. I can't see how it closes. And I know we've been through periods of high inflation before. I think it was the 70s in the UK, and somehow society rebalances, and somehow the lower and middle economic classes do get to rebuild themselves. But does that also just come through a grind of being building a productive economy, or does it actually require government intervention?
Well, I think the part of the problem is that it gets that way in the first place, partially because of government, right? So when we focus on the topic of redistribution, we often think of from wealthy to the poor, but often that's in response to so many decades of kind of quietly distributing money from the poor to the wealthy. Yeah. So for example, in the 2008 banking crisis, you had all these banks making all these crazy loans, bankers making crazy bonuses, and then it all blows up. And instead of letting all their bank equity go to zero and get wiped out and kind of all get just sorted out, they said, well, we'll come in with emergency loans and sometimes outright capital injections during the worst time. And then they have like 1 year of kind of low bonuses, and then they go back to huge bonuses again because they got bailed out, whereas the average homeowner didn't really get bailed out. And then even during COVID, everyone's focused on the stimmy checks, right? They're like, that's what drove inflation. But if you actually do the numbers for how much debt was created per household, it's tens and tens of thousands of dollars, even though that's more than most families got. And it's because it went into other things. It went into billions of dollars for airlines, for example. It went into PPP loans that turn into grants. And a lot of that found its way toward wealthy people. There are people running a law firm or an investment firm or a tech firm, and they had no intention of laying people off, but they still get this big loan that turns into a grant. So, the average person got, say, a few $1,000s in stimmy checks, whereas the partner at a law firm could have gotten $100,000 or $250,000, sometimes $500,000 or $1 million. They get a really big check. And that also feeds inflation. Those people then go out and they buy a second house, or they buy a nice car, they travel a lot, they stay at hotels, they go to restaurants, and that drives up inflation as well. So I think whenever I talk about the topic of redistribution, I always like to point out that it's not just the ones you see, it's also the invisible stuff that gets swept under the rug and it's kind of always happening in the background. So it's partially how we got here in the first place.
Travis Kling said to me a long time ago, I think you know Travis, yeah. He said quantitative easing is socialism for the rich.
Yeah, pretty much. And for and also for the government itself. And it depends on what policies the government's running, because it basically what it does is it finances the government, even though they don't like to phrase it like that. And then it depends how the money is spent. So for example, in Japan, where they're doing it a ton, you could argue at least they're doing it on, healthcare, which is pretty cheap for them despite their age. And it's going mostly toward domestic things. They're not funneling it into war, for example. They're not funneling it toward the top. So it's a rough situation, but there's a high degree of social harmony there, and it's not as people aren't as frustrated about it, because in the U.S. we're doing a similar thing, except a lot of that gets funneled toward the top, and so it goes toward people that already have more, and so it shows up more in political polarization, and that's why I've argued that basically Occupy Wall Street and the Tea Party were kind of two sides of the same coin. They were right and left. But they're both basically frustrated that we have this very flexible foundation of money, which makes it you can always create more of it and kind of give it to some group. You didn't tax it from anywhere else, and it was kind of invisible. And people often focus on the more visible things, even though all that invisible stuff kind of happens under the hood or gets swept away over time and then forgotten about.
We're often told, and I was taught this when I studied economics, that deflation's terrible. You don't want to have deflation because people will stop spending because they think things are going to get cheaper later on. Is that a reality or is that a myth? And does the reverse work true in that in periods of inflation we get a widening in wealth gap? In periods of deflation, do we get a closing of the wealth gap?
So it depends on the fiscal policies at the time. But in general, the reason deflation gets a bad reputation is because deflation is very bad for highly leveraged systems. So we talked about the instability of fractional reserve banking. Deflation is very bad for fractional reserve banking, which is what our banking systems currently are.
So it's bad for who? Which people in that? The people who have the debt? Because I'd say that's
anybody who has a bank account.
Yeah,
which is most people. It's one of those things where when you encourage the debt to build up to those extreme degrees, and then you say, well, now we want deflation, you're going to have a really bad time, and people are going to find it intolerable, and then they're going to want out of it. So that's where it gets its kind of bad reputation. But in a more equity-based economy, so one that's less debt-based and is more equity-based, then deflation's a good thing. It's good for prices to go down over time. I mean, the fact that, for example,
that's what Jeff talks about.
Yeah, his exact point. So if you look at, say, the late 1800s in the U.S., there was long stretches of deflation, and yet that was a kind of a major age for new technological growth. The U.S. became the world's largest economy at the time when it often had persistent deflation. The Renaissance was basically built on a hard money situation. You had this, the gold floor, and that went undebased for a very long period of time. Those things can be very good. It's just that they get a bad reputation because the way we've structured things for the past century and a half or so just don't mix at all with deflation. So we think deflation's bad, even though at the foundational level, it's not.
But deflation is worse for the people with the most debt.
Yes.
Because it's harder to pay it off.
Yeah, basically, you owe debts in a unit of money, and the amount of money supply is shrinking.
Yeah.
And at any given time, if you let it build up, there's a crazy ratio. Like in the global financial crisis, in the U.S., there was something like $50 of debt for every dollar of base money.
Okay.
Which means that most of that debt is structurally unpayable. And so you get a situation where if you let it deflate, it just starts feeding on itself. You never should have gotten it that blown up to begin with. And so that's why you almost never see a banking system implode on itself for too long, because eventually, no matter what someone's kind of view is, they say we have to stop this and reverse it. So all the incentives always kind of point toward more inflation, more supply growth, make the debts more payable. And so that side wins like 99 times out of 100.
And with the government holding the most amount of debt,
yeah,
they have the most incentive to avoid deflation.
Yeah, it's extremely rare for a government to ever default in its own currency when they can instead default gradually through inflation and expansion of the money supply instead.
But if you were a small country with no debt, would you favor deflation? Would that make you a stronger country?
I mean, deflation in that sense is prices going down because technology is getting better.
Yes.
I mean, that's good. That's a good thing. We see it. I mean, our best performing sector is technology, and that's one of the few areas where deflation's happening because it's strong enough to override the money supply growth. So, for example, it used to, the cost of a megabyte of storage used to be prohibitive, and now that's trivial. We buy terabyte drives, for example. And so technology, that field is able to kind of make some things cheaper so quickly that it even overrides the fact that money supply is going up on average 7% per year. Most sectors can't overcome that. But it's funny that people think of deflation as a bad thing, whereas it literally happens in our best performing sector on a regular basis.
Yeah, so it feels like central banks are playing God with the economy.
Yeah.
With a bias towards ensuring government's best position to finance what it needs to finance.
Yeah. Well, it's funny. They have a mandate for stable prices, and they interpret that as 2% average inflation, which is rather arbitrary.
I mean, over at Royal Free Op, they wrote a fantastic article on this, and they said even at 2%, this has a compounded detrimental impact on the poorest in society.
Yeah, one way to put it is that every contract that exists, so everyone's wage, every business supply contract, that's denominated in the currency of a country. And so a central bank that can come in and increase the amount of currency supply or decrease the amount of currency supply, they're basically deciding who on which side of contract is winning. And on average, if you're a wage earner, you're basically on a treadmill because every year you have to get a raise that keeps up with inflation. And it's not just the CPI inflation you're trying to keep up with. You want to have, ideally, you want to keep up with the inflation of prices for the scarcer things like houses, which is generally a higher number than what we see with CPI. So a lot of people, when they go to their boss and they say, I need like a 7% raise, the boss is like, well, you're not 7% better this year than you were last year. But it's really because money supply grew 7%. And the person's saying, look, I want to keep up with money supply growth. I don't want to get diluted. And so basically, the more inflation there is, the more burden it puts on the people that have the status quo. They always have to fight for price increases for their wages, for their business supply. Whereas if you had no inflation or deflation, then it benefits whoever has the status quo. Because, for example, if someone earns the same salary every year, but things get a little bit cheaper over time,
they're fine.
Then they're doing well. And of course, give that enough years, maybe the employer has to try to negotiate their wage down a little bit and argue that, look, there's been 10 years of deflation and we need to trim it. But at the same time, seniority and experience could make up that gap. So basically, it just kind of determines the outcome of millions of contracts in a country.
Yeah, it's a really fascinating way to look at it. If you have the lens of operating a company, I've obviously got a few and got various employees, but when people ask for a pay rise, I ask for two reasons. Sometimes they'll come for their annual review and it's like, I think I deserve more. I'm doing more. I'm good for the company. I'm productive. And it's usually very hard to argue with if they have been.
Yeah.
But more recently, last couple of years, it's I need more money because everything's getting more expensive. And it's a real challenge because it's not like we as a company are always bringing in more money. Sometimes we're bringing in more money or the same amount of money, but our costs have gone up and we can't raise our prices. Yeah. And so it's a proper lived experience of the consequences of inflation. It's bad.
Yeah.
And I'm seeing it at a minimal scale, compared to a place like Argentina, I'm seeing tiny inflation.
Yeah, and I've, a lot of people, when they focus on inflation, they focus on savings being eroded. That's kind of the first thing people think of. But it was in Egypt where I was talking to a videographer, and he was pointing out that, he often does work for foreign clients, so he's often charging in dollars. And even though by the time it hits his bank account, it's in the local currency, but he was still better off than many of his peers when they had major currency devaluations, because if he charges, say, $100 for a job, and then there's a big currency devaluation, he can still charge $100 for a job, and it results in twice as much local currency. And so he automatically gets a raise that kind of keeps up with the devaluation that's happening. Whereas many of his peers that are doing more domestic work and charging in the local currency, if you do a poll and say, how many of you managed to double your prices in response to the fact that the currency just got cut in half relative to the dollar, and it's virtually zero. So even that unit of account that things are denominated in can make a huge difference for someone, in addition to just their savings being eroded by by inflation.
I guess with debt, it becomes this kind of doom loop in that if government's holding debt and they're not paying down the debt and there's periods of high inflation, they're going to have to continue to borrow more and more.
Yeah.
And this is why we get hyperinflation, because we saw 800 billion during the global financial crisis, and then whatever it was, was it like a couple of trillion during COVID? And then I've seen reports of like 4 trillion this year. And it's a growing debt, but that it's still a liability they have to service the interest on.
Yes.
And so, in periods of high interest, that feedback, there's a feedback loop into it.
Yeah.
It feels, it feels evil, firstly. But it feels like this is purely and entirely a political problem.
Yeah, and I think what makes it hard is that it's built up over time.
Yeah.
So, right, and that's why inflation is successful, because it obfuscates the cost. Like if you had to do something and you had to raise taxes to do it, people would know right away. Like I say, we're going to go fight this war. We're going to do a war tax. It's going to be very unpopular, most likely.
Yeah.
Whereas you say we're going to do a war, we're going to print money. We're going to rack up debt that's later going to get bought by the central bank. The cost kind of gets put away for years or decades. And so, for example, now we're sitting here with very large debts and deficits, and some of that is driving inflation. And everyone's saying, is it Biden's fault? Is it Trump's fault? Is it both? And no one's sitting there thinking, well, is it related to the Iraq War, for example, decades ago? Was it related to how the entitlement systems were set up decades ago? And yet all of those past decisions partially led to where we are now, but those get forgotten about, which is why it was successful from their perspective in the first place. They got to push the cost onto someone else, and it becomes someone else's problem.
Hence why we need to separate money and state, because politicizing money and giving access to the money printer to governments leads to corruption, overspending, irresponsible policy, and it can affect entire countries of people.
Yeah.
We have extremely poor countries who are extremely poor because of the decisions made by the people who run that country.
Yeah. And by controlling money, those decisions can be so ubiquitous that they can affect everyone. And so, like, we're here at the Oslo Freedom Forum, and when they talk about Bitcoin, it's often focused on the censorship resistant aspect. But you can argue that constant inflation is also a human right issue. It basically prevents people from building up liquid capital reliably. It either forces them to monetize illiquid things like real estate, or just keeps rug pulling them year after year after year, and they're never able to build any sort of serious capital and kind of better themselves.
If we were to think on an ideal scenario, do you still believe a central bank inherently is a good idea if it wasn't politicized, if it had pure independence?
I think they really only make sense in the context of fractional reserve banking. I think if you had a money that was both scarce and fast, it's very dangerous to build fractional reserve systems on top of that. So, I think a healthier system is one that's it's duration matched lending. I think that's ultimately the most sustainable way to do it. And the funny thing is, right now, when you hear the phrase like shadow banking, right, you'll often hear that there's banking and then there's the shadow banking market. Some of that shadow banking is actually full reserve banking by another name. So there are, for example, credit funds. They'll take in investors' money, and then they'll lend it out in a variety of ways. But that money that they've put in is kind of locked in. There's no guarantee for them that they have kind of ability to withdraw in any kind of tight time period. And they know that going in. That's how those funds are supposed to work. And so they can say, look, we're illiquid at the moment. We can't process all the withdrawals. And that's normal in a duration matched lending environment. I generally argue that central banks aren't necessary at all unless someone is trying to normalize and run a fractional reserve system.
So how do you think this will work in a fully Bitcoinized system? Because we have seen recently, obviously Biden vetoed it, but banks want to custody Bitcoin.
Yeah.
And so where does that sit within their assets or their balance sheet or what they do? And how much risk does this present holders of Bitcoin who are custodying with them? Do you envisage a scenario where they'll fractionally lend based on the deposits of Bitcoin, or do you think they will segregate that from the rest of their business?
I think that'll less likely be an issue for a while because there's not that much demand for Bitcoin denominated loans.
Yeah.
And historically where there have been, it's for leveraging. It's for you're borrowing Bitcoin, then you're buying Grayscale, for example. That's kind of an old trade of the past. There's not a lot of like commercial uses of a Bitcoin loan, while it has this kind of big price variance. So I think it's less about that and more just about, exchange hacks or custody hacks and things like that. For example, I don't really expect Fidelity or BlackRock necessarily to fractionally reserve it or rehypothecate it because it's such an easy mistake for them to get caught out on it. But it's possible. So for me, I think the bigger risk is probably state confiscation. That if everything kind of gets pooled into big, large buckets, they can say, look, these things are no longer withdrawable. And you can make up reason X, Y, Z. You can say it's
6102 in our Bitcoin.
Yeah, or at least saying, it's walled garden Bitcoin, and we can't let it into the wild because of terrorist financing or whatever the reason they can do. That I would consider probably the bigger risk, because I'm less concerned around how Fidelity manages their Bitcoin or BlackRock. I'm more concerned with what they might be told to do with it one day.
Because they want to steal it? Because their own economy's screwed? Their own currency's screwed?
It could be that reason. It could also be, over time, the financial systems become more and more surveilled, more and more controlled, and they don't really like free-range Bitcoin too much. It's harder for them to control free-range Bitcoin. So they could eventually clamp down on that, especially if there's some major negative event and people get very emotionally driven. Imagine if 9/11 was obviously a very tragic event, but then they were able to get the Patriot Act through fairly easily, and they were able to drum up people's desire to go to war with a country that wasn't even involved in the attacks, Iraq. Imagine if there's some sort of similar major event and they say, look, we have to clamp down on Bitcoin. We can't let terrorist financing happen with it, or we can't let X, Y, Z, or we have to have more control over this. And you can get kind of an excuse to block the exits. Even just financial repression. Like, for example, when Argentina is having a currency crisis, and they pass things saying banks can't offer it to their customers, or even fintech companies can't offer it, and they never say it's because we're having a currency crisis. They say, look, it's money laundering and AML, and we have to maintain bank stability. They'll say any number of kind of normal sounding jargon for why they can't do it, when really it's because they want to slow down the currency crisis. You see that with Nigeria, you see that with Turkey. And the way they're often phrased it is either something like that, like we want to do safety and stability, or they'll blame, quote, speculators. The people are speculating with the currency. And so they'll try to block the exits there and kind of demonize a certain group. So I do have concerns around, in many jurisdictions, eventually a sovereign entity kind of taking over those big Bitcoin honeypots.
Shit. Okay. Not your keys. One of the other interesting things I've been observing is the interest rates when you borrow against your Bitcoin. You borrow dollars. So if you go to an Unchained or a Ledden, you'll be paying double-digit percentage interest rates. Generally, much higher interest rates than you'll pay on a mortgage or even on a loan. And I know there's a combination of risk factors here. But if you then I've been looking at the rates you get, say, in DeFi applications. And by the way, anyone listening, I do not recommend using DeFi. I don't trust it. But I do find it quite interesting. The rates there are a lot lower. And it feels like that's been a technology solution to get the price lower. And that they're not having to go to physical banks to borrow money and pay an interest rate. They just have to collateralize the loans.
Yeah.
And so that, in some ways, feels more like a free market for rates than those like Ledden and Unchained, who are, are essentially subject to the central bank interest rate.
Yeah, I think there are interesting price signals from that, but I think also part of the issue is people underestimate the risk that they take on, and so with DeFi, it's less risky for the borrower, but it's very risky for the lender, because in addition to liquidation risk, you have hack risk.
Yeah.
And that's something that often gets kind of overlooked, I think. So it's not necessarily priced accurately. But I would expect probably over time for the Bitcoin collateralized lending rates to go down, because if you look at mostly how they work, like the ones that do it properly, like Unchained, for example, there's no rehypothecation. Those have very low loss rates. I mean, zero in many cases, because you're fully collateralized by the Bitcoin. It's a liquid market. Technically, the only way that you could really, as a lender, lose money is if Bitcoin has a very liquid loss in price. So it basically it would lose value so quickly that you can't even sell the collateral and recoup the loan. So outside of that very specific scenario, it's a mostly risk-free lending. You'd expect the rates to probably go down eventually, but it's not a market that I follow super closely.
Actually, with Lyn, they offer two different rates. They offer segregated protected funds and commingled, and I assume rehypothecated fund options, and you pay a higher rate to have it in the segregated wallets, which is a kind of interesting option because it's like, oh crap, I want that lower rate, but they're pricing in risk, and I think most of these things is quite interesting. I'd rather have my pricing coming in from risk, and I have the choice, than a central bank setting the price of money. Yeah,
I agree. And I think that then it just comes down to making sure that the terms are known to people. So one of the criticisms that people have against fractional reserve banking is that the depositor often doesn't really understand how that works. That it can be categorized as fraud because, like if I go to my bank and I sign up a bank account, and I'm signing whatever long things they're doing, it might say somewhere that they could have liquidity issues or something. But most people, when you ask them, a lot of them think the bank actually has their money.
Yeah.
And so it's like, would it be the same if everyone was kind of educated on what exactly they're signing up for when they sign up for fractional reserve banking? But yeah, in
they
general,
don't really want you to be educated.
Yeah, I think they don't really want you to. So I think you can argue that a free market, especially when it's an educated free market and people know what they're choosing, I think obviously that's better than a centrally controlled price for money.
Right. So do you think we will end up in a place with no central banks there eventually, long term?
I mean, if the more successful Bitcoin is, the more that makes that likely. I don't think it's going to happen in 5 or 10 or 15 years. But I think over the long arc of time, it's certainly possible. And that's why I'm less interested in kind of movements like end the Fed. And it's more like I'm interested in building an alternative and seeing that outcompete the Fed.
Grow the Bitcoin.
Yeah.
End the Fed. All right, Lyn. We'll keep this one short because we both want to go enjoy the rest of the Freedom Forum. And thanks for taking some time out to do this. Don't know when I'll see you next. Nashville?
I'm not going to go to Nashville this year. I'll be in Egypt.
Wow.
Yeah.
Okay.
Yeah.
Pacific?
Yep. I'll be there most likely.
We'll see you in September.
Yeah. I'll see you there.
Thanks, Lyn. See you later, everybody.